out an iron butterfly that appears to have a guaranteed profit. So firstly, remember, before you ever enter any options trade, please make sure you know how to close it. I'll pin a video in the comments section below where I show you guys how to close out of any options trade. And remember guys, if you haven't already, please make sure to check out Webull. Right now you can get 12 free stocks valued up to $32,000 by using my link in the description below. Webull is a commission-free online trading platform that allows you to invest in stocks, options, and crypto. So go ahead and check out Webull, guys. Again, I'll put a link to them in the description below. So let's go ahead and take a look at this iron butterfly. So firstly, remember, an iron butterfly is meant to be a neutral strategy, and that's going to be implemented for a credit, which means you'll have to put up collateral, okay? So what I'm going to do here for today's video is I'm going to be using a ticker symbol BLNK to show you guys this. So this is going to be Blink charging. Again, everything I'm about to show you here are just examples, so don't copy these exact same trades, right? Now I'm going to be using Blink charging for a very specific reason, and I'll talk about that reason later on in the video. But remember, before you actually go into the options and implement any trade, two things you always want to check. First thing is commission fees, especially with the iron butterfly. You are opening and closing multiple contracts. If you're on a broker with high commission fees, that could eat away at a lot of your profit. The second thing you want to check is assignment risk, right? We are going to be selling options. Anytime you sell an option, there is risk of assignment. You want to avoid being early assigned due to the ex-dividend of a stock. So always check, does the stock have a dividend? If it does, when is the ex-dividend date? You want to avoid selling options on the week of the ex-dividend date. If you do sell options that week, you want to close out 2 days before. Now, Blink charging doesn't have a dividend, so I wouldn't have to worry about being early assigned due to the ex-dividend of a stock. And Robinhood doesn't have any commission fees, so I don't have to worry about that either. So let's go into the options here. Let's take a look at this iron butterfly that I want to show you guys here, okay? So first thing we're going to do here, number one, you don't need 100 shares of the stock to implement the iron butterfly. Number two, you want to choose a proper expiration date. Now, I'm just going to leave my expiration date as it is for September 16th here. And then the next thing you want to do, this is kind of the hardest part of this entire strategy, is you want to determine what price you believe the stock will be at on expiration, right? So on September 16th, when the market is about to close, what price do I think Blink will be at? So let's say I think Blink charging will be at around $19 a share. So I would go ahead and I would first start by switching over to sell here, and I would go ahead and sell a call at the option that has the closest strike to that price. Now there is an option with exactly that strike, so I could just choose this one right here. So again, if I think Blink charging will be at $19 at expiration, I would start by selling a call at the option whose strike price is as close to that price. Then after I have a call that I'm selling here, I would switch over to puts now, and I would also sell a put at that exact same strike. So I'm selling a call at the $19 strike. I would also sell a put at the $19 strike. And finally, I would switch over to calls again. Now I want to buy a call, and I want to buy a call with a higher strike than the strike of the call that I'm selling. So here's the call I'm selling. I want to buy a call above it. So I'm just going to buy the call right above it at $19.50. And now finally I switch back to puts because now I also want to buy a put. Now I want to buy a put with a lower strike than the strike of the put that I'm selling. Now here's where it is very important that you choose the proper put here. So notice the calls we have, notice the distance between them. The distance between them is 0.5, right? We have 19 and 19.5. So the distance between them is 0.5. So the distance between the puts now that we're going to choose should also be 0.5. And so we're already selling a put at the $19 strike. That means I have to buy the put at the $18.50 strike because then these two would be also 0.5 away from each other. So I do have to buy this put. If you choose one a lot lower, it's going to be a completely different strategy. So I would go ahead and click on that one and choose it. And so now what ends up happening a lot of the time, and again, I still see this every single day on Discord, on Reddit, other places, is, someone will, come up with this strategy and they'll scroll down to the P&L chart down here. And what does the P&L chart tell us here? It's telling me my max profit is $56. And then for max loss, it just has a dash. Basically indicating that it has no max loss. And then if you actually start to look here at the P&L chart, you notice that no matter where this price goes to, you end up making some money, right? And people will see this and they'll be like, oh my God, like I can make a guaranteed profit here, right? And then what they'll do as well is they might go over to option strat, right? Because option strat visually shows you what a trade will look like. So they might come in here as well and they'll actually go ahead and also place the same trade here just to make sure that what they're seeing is true, right? So they'll come in here, they'll go over to whatever stock they're using, they'll choose their proper expiration. So we're using an iron butterfly on Blink. Again, we first started by selling a put and selling a call at the price we think Blink will be at expiration. So we said 19. Then I said, okay, now I need to buy a call with a higher strike. So I chose the one right above it at the 1950 with a higher strike than the call we're selling. And then I said, okay, finally, you also need to buy a put with a lower strike than the strike of the put that we're selling here. And again, these need to be the same distance as the calls are. So the calls are 0.5 away. Puts also need to be 0.5 away. So here's the exact same iron butterfly I'm showing you on Robinhood. So if you actually come in here, you also end up seeing that you're going to get a $51 credit. Your max profit is $51. And again, there's no max loss here. In fact, there's a min profit, basically saying, you're leaving with at least $1 if you enter this strategy, right? And so I get this, again, a question every day. People post about this every day. So the real question then, right, is this possible? Can we actually do this here? And of course, the answer is no, we cannot do this. And in fact, let's take a look at what happens if I actually were to try and place this order. So if I go back up here, so basically here it's saying max profit $56. So that would mean that I would have to enter 4.56, right? So that's what it has here. So this is basically saying I'm going to get a $56 credit. Now remember, with the iron butterfly, you also have to put up $50 in collateral. Well, if I'm putting up 50, but I'm getting 56, that means I would have to at least make $6, right? But here's the thing. If I go to review order here, and again, right, min credit 56, collateral 50, and I actually try to submit it, let's take a look at what happens. Error. Order premium must be less than collateral, right? So Robinhood is smart enough to know that this is just not possible. This is not, you can't do this, right? There's no such thing as free money in the stock market. And it's basically saying, hey, the premium you're getting has to be less than the collateral. Otherwise, you'd be guaranteed a profit, and we're not going to allow that, right? So even if you see this and you try to place that trade, you're going to get an error every single time, right? It's not going to let you place it, and then all of a sudden you found a glitch where you can make, an infinite amount of money. Now, the main thing I want to talk about here, right, is, let me go ahead and do this trade, the exact same trade again. So if we go back and we look at the trade we actually were trying to do, right? So we were trying to sell a put there, and then sell a call again, same strike, right? So, and then buy a call, right? Higher strike, and then we bought a put with a lower strike than those calls that we're selling, call and put that we're selling. So right here, right? So here again, this is the exact, see, sell, call, sell, put, buy, call, buy, put. So buy, put right here, right? So again, this is the exact same one we were just looking at, right? So here's the main thing I want to mention here, so in case you see this in the future, and so that you understand why this is happening, because this is a very important thing when it comes to trading options, right? So again, we're trying to get filled for 0.54. The reason for this is that there's a very wide bid-ask spread here, right? Goes from 0.34 to 0.73. This is pretty wide here. Now, the thing about the bid-ask spread is that its primary determinant of the primary determinant of this bid ask is the trading volume. That's why it chose Blink for this video, because Blink charging doesn't have high volume, right? The trading volume is very, very low. And since that's the main thing that determines the bid ask is going to be very, very wide. And when the bid ask is very, very wide, you start to see situations like this that just don't make sense, that just aren't possible here. And then the other thing to note about this is that with a wide bid ask, it's going to be a lot harder to get into the trade. It's going to be a lot harder to get out of the trade. And again, as you guys see here, it's going to lead to false promises, right? So ultimately, market makers use wider bid ask spreads for illiquid shares to offset the risk of holding low volume securities. Okay, so ultimately, if you want to avoid seeing things like this, and if you're having a hard time getting into a trade, getting out of a trade, you always need to check the volume of the stock. If it's a stock with pretty low volume, you're going to see a lot of situations like this, right? Where the trade doesn't make sense, you can't get into the trade, or if you get in, it's going to be very hard to get out of the trade. And again, if we take a look at Blink, right? Blink charging, what's the volume? Average volume, 732,000. You compare that with something like SPY, right? If we take a look at SPY and what the average volume for SPY is, we're going to see that for SPY, the average volume is 83.7 million. Way, way more. And that's why if you're using SPY to trade options, it's a lot easier to get in. It's a lot easier to get out, right? The bid ask, if you take a look, is going to be a lot closer to each other because, again, it has a lot higher volume. So anyways, guys, I just wanted to talk about this here. Again, I still see this a lot everywhere. So if you guys have any questions about anything I just talked about, feel free to leave them in the comment section below. Check out the Discord, link to it in the description below. Hope you enjoyed the video. Let me know what you guys think, and I'll see you guys next time.